Welcome back. You're watching Financial Planner. Come April 2012, there's going to be a brand new tax code, and on today's show we're talking about what are the things you must know in preparation for that. You might think, hey, 12 months, it's a long way off, and I'll pay attention to it like just a day before it's actually implemented. But over here on Financial Planner, we believe that you must plan. So get ready, and in case you have any investments, what are the things that you must pay attention to at this point? And we'll discuss all of that in simple, plain English with our certified financial planner, Sumeet Vaid. He's right over here. Sumeet, before the break, we were talking about how the new direct tax code may affect your investments, your bank deposits and things like that. But I want to ask you about mutual funds. Most of us have money stashed away in mutual funds. What do the new proposals say?
I'll start off by highlighting importance of mutual fund, and I think for any retail, individual investors, family-oriented investor, they need to access mutual fund as a route of getting into capital market, whether it's equity or debt. The importance of that cannot be ignored, and the kind of performances they are delivering cannot be ignored. I'm highlighting this, especially in today's era when there's a lot of bad press happening on mutual fund. It's not all that bad. They're doing fantabulously well.
Right.
At that point, let's classify mutual funds into equity mutual funds and debt mutual fund, and let's go through the direct tax code bit in this. So in the equity mutual fund, what direct tax code is hinting at is the continuation of long-term capital gain exemption. So that means if you're an equity-oriented mutual funds more than 1 year, you continue to get the long-term capital gain exemption, which is there as of now. If it is short-term capital gain tax, which is less than 1 year, there's an interesting twist which they are doing. So if your slab is 10%, the tax rate for that will be 50% of that, which is 5%. If your tax slab is 20% and you're withdrawing your equity mutual fund less than 1 year, it becomes short-term capital gains, it'll be 50% or 20%, which is 10%. And in case of 30%, it'll become 15%.
It's a lot of numbers. You lost me at 10% somewhere along the way.
No, but it's in a way, it's also kind of giving me a break, but trying to saying that your income level doesn't demand us to be giving you a flat rate of short-term capital gains kind of thing. So in a way, it's pro retail investors.
It's pro-retail investors, and that's all we need to know at this point.
That's right. It's good for people who will be investing in equity-oriented mutual funds in terms of trying to do that. The second aspect in mutual fund is dividend, and that goes as dividend currently out of equity mutual funds are tax-free, but as per the new law, as per the proposed direct tax code, they might get taxed at 5%.
At 5%.
That's right. And I'm just saying the word might out here because there's still 3 years for it to really get implemented.
True.
So let's see how and what kind of things in terms of finer prints really emerge out of it. But if you see case-to-case basis, it's good. It is giving benefits for people to access capital markets through the route of mutual fund more than 1 year, which is long-term, which is the ideal investment for any kind of equity investments.
Right, and like you said, it's a way that you can invest in a safe manner, in a systematic manner, and make sure that you can also enjoy the sort of gains that we're seeing in the markets these days.
That's right. This India's growth story.
Right,
best
everyone.
Way to, one of the better ways, I'll not say best, one of the better ways of accessing it through our equity-oriented mutual fund.
Okay. Now, moving on from that, I want to look at home loans. Looking at my home loan, right now I get a tax deduction on the interest on the home loan. What's going to change?
Okay, there are two components in home loan, and after finishing home loan, Smithy, we'll try and come back to the debt fund. I think we
need to talk about that too.
Yeah, we just need to finish on that. So in home loan, there are two components. One is interest, which is on the home loan, which you have to repay, and the second is the principal repayment. And in a current era, you used to get tax benefit in the both, which is interest repayment as well as the principal repayment. As per the direct tax code, the interest repayment, benefit continues to be there on tax exemption basis, but the principal repayment goes away.
Okay.
So the point which we need to really understand for all those people who are taking home loans right now or have taken home loans but will continue beyond 2012, the tax benefit which are currently available on home loans will get reduced.
Okay.
So in a way, the cost of home loans to you on a post-tax basis goes up.
Okay.
So that's one thing which one need to really remember about.
One needs to remember that.
About it.
Next.
And debt funds, as I mentioned, we forgot to cover debt funds in the earlier part.
Go on.
So fixed income funds or debt funds, which are an important part of the mutual fund industry, and most of Indians, if you really go by data, are more comfortable investing in debt. For them, it's very important to understand what is the direct tax code in this. So direct tax code in the debt fund doesn't change significantly. Okay.
Okay.
What it really attributes is on a less than 1 year basis, which is short-term capital gains, there might be some tweakings which might happen over a period of time. But on a long-term basis, it doesn't change anything, and it continues to really go and give them the same benefit. So equity funds, debt funds, we covered, and housing,
The
benefits.
home loans.
Yeah.
We also looked at that. Now, there's still a little bit more ground to cover. We'll talk about provident funds. What happens if you want to withdraw your money from your provident fund? Will you be paying any taxes on that? We'll find out with Sumeet in just a little bit from now. You can also email us your questions at financialplanner@utvmoney.com. Stick around, more after this break. Welcome back. You're watching Financial Planner with me, Smriti Rao. We're talking about the new direct tax code proposals. Come April 2012, there's going to be a new tax code. We're talking to Sumeet Vaid about what we need to know in plain, simple English about all the things that might or might not change in our own lives. Before the break, we talked about the mutual funds, home loans, and what the new DTC proposals might mean. Looking at Provident Fund right now, I know that there's no tax on Provident Fund. When I deposit my money, when I get interest on my money, when I withdraw my whole balance on Provident Fund, it's exempt. So it's EEE. Does that continue?
It continues, and also one need to highlight, this was a section where maximum amount of noise was there in media of saying that government wanted to move away from exempt to exempt taxed.
That is when you withdraw your money that you get taxed on it.
That's right. It hasn't happened. I think they've kept it over a period of time. They'd like to, implement it. But as of now, exempt continues for PPF, Employees Provident Fund, superannuation, and NPS, which is National Pension Schemes, which Government of India has launched. So it continues for them. So there's nothing much to worry about. What has changed though is there used to be equity-linked savings schemes in mutual fund, which are not qualifying under this limit of exemption under that 1 lakh limit which they have done. That's only available for PPF, EPF, superannuation fund, and NPS. It's not available for ELSS, and it's also not available for unit-linked investment plans, which used to be there. So whatever was there continues. So that's good news. ELSS and ULIPs are out of it. But having said that, when you are planning your investments linked to gold with help of a financial plan, over a period of time, you will see that it's not that big a dampener of you not getting a tax break. So I will say that yes, you are losing on tax break on ELSS, but don't lose heart because they still have some good options left with you.
Some other good options. Before I wrap, Sumeet, very quickly, if I'm going to retire before 2012 or around that area, like maybe 2012, 2013, how do my plans change?
Okay, now if somebody is retiring 2012 post DTC, do my plan change significantly? It doesn't change significantly in a way that most of your investments, if in equity mutual funds, should be more than 1 year. So that's long-term capital gains, you continue to do that. Your PPF and Employees Provident Fund continues to be EEE, so there's nothing much to worry about. Your direct equity investment, again, more than a year, doesn't change anything itself in terms of trying to do. There might be some impact to do with your, housing property. There might be some more impact which are not very clear in terms of treatment of rental incomes, which you might have get from housing property. So just be clear about it. Try and get clarity from a chartered accountant who can tell you what needs to be done. And there are some gray areas where nothing is being mentioned about, like for example, dividend tax treatment on fixed income funds, on the debt side of it. So people will wait and watch for it. But having said that, no major impact.
No major impact. But overall, I mean, it's for a lot of people who were overwhelmed, frankly, by the amount of news coverage that the entire issue generated, and rightfully so, because it's very important. We managed, I think, we did a good job of decoding it and simplifying it and speaking in plain, simple English about what this means for your money. We hope you enjoyed it. We hope it was educational, the entire show. You can suggest story ideas to us. You can email us at financialplanner@utvmoney.com. You can also find me on Facebook at facebook.com/Smriti Rao. Now, I have to take a break right now, but I want to thank Sumeet. Sumeet, thanks so much for coming in. It was a pleasure to have you. Do stay tuned. There's lots more coming up, including at 6 o'clock. Right after this, we'll be taking a closer look at Mukesh Ambani's next big foray as he tries and diversifies into the healthcare segment. Plus, Maruti's expansion plans. What are they doing to try and meet the increasing domestic demand? We'll have all of that and more in just a little bit. Stay with us.